Now, as it stands at the moment, the base metal suite is largely being dominated by macro factors. However, the fundamentals shouldn't be ignored, and they will be important in separating out price performances over the year.
Welcome viewers catching this session for the assay. We are gaining an expert view into base and battery metals and the outlook in the near term. And Natalie Scott-Gray, Senior Metals Analyst for Base Metals in EMEA and Asia at StoneX, is going to be taking us through some of the supply and demand dynamics for base and battery metals at this very interesting point in the market cycle. So Natalie, thanks very much for your contribution here, and I'm looking forward to seeing this presentation, and I'll hand over to you.
Thank you very much. It's my pleasure to be able to be here today, and good morning and afternoon to you. So today, as Adam said, I'm just going to give you a market update and then a price outlook for the base metal suite. So just moving on to our disclaimer that I have to hold here. Right, so let's dive in. So over the next 20 minutes or so, the topics that I want to cover is, firstly, I want to have a look at the major macro trends and the impact that they are playing on the base metal suite from a global perspective. I'm then going to dive into the fundamental story for each of the 6 metals in the LME suite and their price performances. And then following this, I just want to take a minute to talk about the green transition and the benefits it's having on our metals. And then I'll finish up with a quick wrap up of the key points that I've covered. So let's dive in with our macro roundup. So I've named the slide today Macro Headwinds Negatively Impacting the Industrial Metals. As for a large part of this year, not only has price direction for these metals been controlled by macro forces, but these factors in themselves currently paint somewhat of a bearish outlook for our markets. So to begin, our first key macro theme is regarding central banks moving to tighten monetary policy on rising inflation and the expected impact that this might have on global and regional economic growth. Now, as I'm sure we're all very aware, inflation projections, particularly in the West, have lifted dramatically over the last year, with the US CPI reading moving from 2.3% pre-pandemic up to its current level of 8.3%, as a result not only of significant levels of stimulus having been pumped into the economy over the height of the pandemic, but further inflamed by Russia's invasion of Ukraine, which of course, following sanctions, is now threatening Western energy security. Now, with inflation having lifted at the pace it has over the last year and lasting longer than expected, particularly as supply chains have been unable to return to pre-pandemic levels, central banks have had to move faster than expected to tighten monetary policy, which has caught the market off guard, and it's now placing concerns over possible recessions. Now, this has been a major headwind for the base metal suite, with world growth forecasts having been downgraded since the start of the year. Now, on this, we have in turn downgraded our own forecast for base metal demand, both this year and next year, with global PMI manufacturing set to have peaked in 2021. Now, coming on to our second key macro theme, and that's China. Now, indeed here, we expected that the key areas of risk to growth for the country would arise from further COVID-19 spreads, a return to power shortages, and a continuation of weakness in the property sector. And as it stands now, all 3 of these issues have arisen in the country. And as a consequence, we do not expect that China will meet its target growth level this year at 5.5%. Now, please note, this is a target that was established in the annual Congress, also known as 2 sessions back in March, where China's top economic and legislative decisions for the year are made. And finally, coming on to our third key macro theme, and that is energy security concerns in the West following the invasion of Russia into Ukraine, which, as we mentioned earlier, has been a key contributor to higher inflation over the year, as tensions mount and sanctions force trade rerouting. Now, Russia is a major player not only for base metal production, but for energy supply. And as it stands, a key concern in the market is reduced flows of natural gas to Europe following the halting of flows from the Nord Stream 1 pipeline on the 31st of August. Now, this is the largest route of natural gas into Europe from Russia, and the EU had a reliance on Russian natural gas at 40%. Now, indeed, not only did this action result in European natural gas prices hitting their highest level on record, which marks a 41% jump since March 2022, which was the previous on record high, but it has forced the EU to take up power rationing, with the EU agreeing to reduce natural gas consumption by 15% over the August to March period, And this is going to impact our base metals twofold. So firstly, on the demand side, the risk of recession is growing in Europe, with the outlook for high energy prices set to be sustained over the next 18 months. And with higher inflation and consequential rising interest rates, consumer sentiment is being curtailed, along with industrial activity. CRU are actually forecasting that the EU will fall into a recession in the second half of this year, which of course will reduce our expectations for metal consumption. Meanwhile, high energy intensive metals such as aluminium and zinc are first in line to see smelter profitability weaken, with curtailments already having been announced back in Q4 2021. And this is when natural gas prices were 36% lower than where they currently stand. Now, just before I dive into the details of the fundamental outlook for each of our metals, I just wanted to consolidate the major drivers that have impacted the base metals, and really to a large part all of our industrial metals over the last 6 months. And I've compiled that in the chart that you can see. So in very simple terms, in the first quarter of the year, prices were largely dominated by supply fears over Russia and Ukraine, potential sanctions, and the impact that this would have on the energy market. Indeed, we can see that European coal, natural gas, and crude Brent oil hit their highest levels on record by early March. Alongside this, optimism remained that China's economic growth would be supported by stimulus over the year, while metal supply remained tight, with most of our metals still recording a backwardation on the LME, with stock levels remaining at multi-year lows. And indeed, by early March, we saw copper, nickel, tin, and aluminium hit their highest levels on record. However, what a difference a quarter makes, with the base metal suite by the end of Q2 having recorded its worst quarterly performance since the global financial crisis, as supply fears eased and gave way to demand concerns upon extended COVID-19 lockdowns in China, faster than anticipated tightening of monetary policy in the West because of rising inflation, heightened uncertainty over the Russia-Ukraine war, and of course the implication to the energy market, leading to a downgraded outlook for global growth. Now, as it stands at the moment, the base metal suite is largely being dominated by macro factors. However, the fundamentals shouldn't be ignored, and they will be important in separating out price performances over the year. Now, just in addition, I wanted to take a minute to highlight the dominance of the US dollar this year, which holds a negative correlation to the base metal suite. And the example I have here is with copper. Now, this relationship has strengthened over the last 4 months and will be vital to price direction, in our view, over the remainder of the year, with great focus being lent to interest rate rises around the world, being led by the US Federal Reserve. So with that, let's move on to our second point in the agenda, what the fundamentals are telling us. So starting with nickel, which is the best performing of our metals on a year-to-date basis. And as I'm sure we all know, the price action that we've seen has largely been controlled by factors outside the metal's underlying fundamentals. Indeed, on the 8th of March to the 16th of March, the LME closed trading for nickel following a short squeeze, which resulted in the nickel price jumping by 250% in just 24 hours. Now, upon the resumption of trading, the LME installed a 15% daily price limit on nickel, which is also applied to the other base metals. And while nickel's price has fallen back below $25,000 per ton, it is still historically elevated. Looking ahead, price direction for nickel not only will be influenced by a return in LME trading volumes, but it is likely to take its cues from any loosening in Class 1 tightness, which will be dependent on the spread of new and alternative routes to produce Class 1 nickel, particularly coming online in Indonesia, given that global nickel stocks remain at historically low levels. So therefore, turning to the fundamentals, if we compare our outlook for nickel from the beginning of the year to now, there is actually very little change. So on the supply side, we've modestly increased our forecast with record levels of NPI production and ex-NPI production within Indonesia, which is being lifted by the expansion of NPI to nickel matte and continued growth in HPAL production. Meanwhile, although we do factor in a potential downside risk coming from Russian production, given the ongoing war, we continue to forecast that the likelihood of the EU placing an export ban on Russian nickel is low, given that Russia is responsible for 15% of global Class 1 supply and 9% of global supply. For demand, our growth forecast has been downgraded moderately upon reduced European stainless steel output, a slow start in China, while Indonesian production is moving to incorporate NPI to matte conversions. Meanwhile, demand from electric vehicles will continue to thrive, with nickel demand jumping by 28% this year, driven in the most part by China. Now, we forecast nickel to remain in a balanced market this year, with a modest surplus of 100,000 tonnes, having rebounded from a 220,000 tonne deficit last year. So turning to zinc. Now, at the beginning of the year, we forecasted that zinc was likely to remain in a balanced market, where supply risks from high energy prices in Europe would be in the spotlight, while consumption was to be modest, given the state of the Chinese property market, and also caps that had been placed on steel production in the country. Now, what we're expecting this time around is similar, but both sides of demand and supply have been exaggerated. So for supply, the sustained jump in energy prices in Europe as a result of the war has meant that profitability for European smelters, which makes up 20% of global refined supply, has continued to suffer greatly, with plants having to go on care and maintenance or be temporarily shut down longer than anticipated. So as a result of higher prices for longer, CRU have estimated that up to 110,000 tonnes of production was disrupted over the first half of the year, and it is forecast that this figure is going to rise to 310,000 tonnes for the entire year, given that we expect both Nystar's Budel and Glencore's Portovesme to remain closed. And this is the key driver behind a wider than originally forecast deficit in 2022. Now, of course, this figure could further escalate as medium to long-term energy contracts are renegotiated. Meanwhile, for demand, we've downgraded our expectations for both Chinese and outside China production, given the weakening view on economic growth. And as a result, we forecast a deficit for zinc to jump to close to 300,000 tonnes this year, underpinning prices. Now, coming to lead. As is a common theme with lead, it has lagged behind the other base metals with respect to price volatility so far this year. And that's because shocks to the supply side are cushioned by 2/3 of supply coming from secondary material. However, arguably one area where lead will face pressure this year has come from the demand side, upon which the automotive industry, which makes up over 70% of consumption, coming from lead's use in lead acid batteries, either as a replacement or indeed for new vehicles, being the key area to watch. Now, if we break down demand this year by region, while both Europe and the US continue to struggle to play catch up with output, given ongoing supply chain pain, in which the automotive industry has struggled to be able to get hold of enough materials, the wider economic slowdown has resulted in demand being downgraded, while optimism for recovery in China over the second half of the year does remain uncertain. Meanwhile, on the supply side, we're forecasting a Q2 contraction, marking the first quarterly dip in production since Q2 2000. Now, this is set to be driven by both primary and secondary output weakening, largely attributed to tight supply and weak margins in China, in addition to the pushback in the reopening of Germany's Stolberg plant, which has been closed since July 2021. Meanwhile, secondary scrap in China has been negatively impacted by the various COVID-19 lockdowns. We're forecasting, therefore, that the lead market will record another year of moderate surpluses in 2022, before extending this surplus almost 3 times next year on higher output. Now, looking at aluminium, the extension and the elevation of supply risks within Europe because of higher energy prices led to aluminium recording its highest level on record at $3,849 per tonne by early March. However, as the year has gone on, there's been a few twists and turns to aluminium supply outlook, which has led to a significant alteration in our market balance. So again, turning back to what we expected at the beginning of the year, we understood that European aluminium smelters, which are responsible for 14% of global supply, were struggling with elevated energy prices. However, we believe this to be temporary, with energy prices starting to cool as we entered the spring months. In addition, we understood that supply could be constrained in China as the country pursued environmental reform. Meanwhile, for demand, although we did expect a year-on-year reduction due to global stimulus pullbacks and a weak Chinese property sector, we forecasted that pent-up demand in the automotive industry and a recovery in supply chains would provide a base level. So if we ask the question of where we are now, well, on the demand side, the growing bearish outlook for global growth has meant we've had to downgrade our demand profile for this year, not to mention ongoing supply chain pain, resulting in continued weakness in the automotive sector. While for supply, we have a regionally split answer. So firstly, within Europe, supply risks have elevated on the back of natural gas prices reaching a new record high level in August, which alongside falling metal prices and premia set to have already peaked, smelter margins are coming under more pressure, with announced closures by end October estimated to reach up to 1.1 million tonnes of capacity. Now, this equates to 12% of total European capacity, which as it stands, if we look at production loss basis, is around or close to 700,000 tonnes. And if we put this against 2021 levels of production, this actually equates to an 8% total output loss. Meanwhile, the expected risk of reduced production out of Russia could start to become realised over the next year. As although alumina supply to the country has been maintained from imports from China, and this was over fears on the back of Australia's export ban and Ukraine's Rusal plant being unable to deliver, which cut out about 2.3 to 3 million tonnes per year of alumina to Russia. Rusal, which is Russia's largest aluminum producer, did announce that not only have production costs risen by double digits, but a lack of equipment could create headwinds. Meanwhile, in China, a surge in aluminium production on the back of reopening of smelter capacity again caught the market off guard, with all-time high levels of output occurring since March. Now, this has been made possible not only by the plentiful availability of thermal coal, but also China's relaxation in emission curbs, with the country focusing on economic recovery. Indeed, there's been no energy intensity target set for this year. So as a result, we forecast that aluminium will record a significantly smaller deficit than last year at about 80,000 tonnes, before flipping into a surplus market next year on reduced demand and maintained high Chinese output. So coming to copper. Now, at the beginning of the year, again, we forecasted a fairly balanced market, driven by improving production on the back of new projects in the second half of the year and a halving in demand growth from 2021 levels. Again, driven by the wider pullback in manufacturing activity, stimulus, and again, the weak Chinese property sector. However, given the developments this year so far, we are now forecasting a deficit market for copper at around 200,000 tonnes. So the key driver for the change in our outlook has arisen on the supply side, where we've had to reduce our expectations for growth from mine production, given not only the social and the political unrest that has occurred within both Chile and Peru, with both of these countries accounting for 2/3 of global mine output, but also being driven by the ongoing drought in Chile, which has resulted in companies looking to build desalination plants, particularly as environmental restrictions and awareness lift. Now, it is worth noting here that our forecast for higher H2 output this year does remain, still being driven by new projects such as Anglo America's Quellavecchio, which is set to come online this quarter, while the second phase at Ivanhoe's Kamoa-Kakula has already been commissioned, coming in 4 months ahead of schedule. Although we do now forecast that Teck Resources QB2 will move from coming online in Q4 this year to Q1 next year. Meanwhile, refined supply is set to jump in the second half of the year as well, driven by a return of capacity within China, which based on current domestic output figures could hit a new record high this year, while our expectation for global demand growth has been lowered, driven primarily by reduced consumption within Europe and Russia, given higher energy prices and a lack of material. Now here we allude to both readily available copper and indeed other materials in the manufacture of end products. An example here is the fact that Ukraine supplies 14% of European wire harnesses for vehicle production, which has further delayed the automotive recovery. And finally, coming to tin. And this year, like several of the base metals, it has been a tale of two halves, with tin hitting its highest level on record by the 8th of March at $48,650 per tonne, before retreating with a year-to-date performance in the red. Now, at the start of the year, a delay in the issuance of Indonesian export permits meant that China faced a tight market, with demand prospects in the country initially set to benefit from continued stimulus and a global pickup in demand, as supply chains were set to improve. For example, the automotive industry, where tin is used not only in soldering, but for circuit boards within lead-acid battery replacements, was set to improve. However, looking at where we are now, the market is turning more bearish. On the supply side, with exports now flowing out of Indonesia and rising TC charges in China upon a flux of concentrate material, in addition to smelters coming back online from maintenance in July, we suspect that overall output this year will lift by about 4%, which is higher than what we had previously anticipated. Meanwhile, for demand, higher energy prices in Europe, continued global supply chain pain, and lockdowns in China dented consumption in both the electronics and the automotive industries. Indeed, looking at the chart on the top right-hand side, that displays current stock levels of tin in both LME and SHFE warehouses. Stocks jumped over the first 7 months of this year on the back of weakened demand, which placed downward pressure on prices. However, over the last 2 months, while LME stocks continued to lift, and they're now at their highest since October 2020, SHFE on warrant stocks have been pulled down back to levels at the start of the year. Now, we're forecasting a similar level of deficit for tin this year to last year at around 9,000 tonnes. Now, as part of our base metal update today, against the negative headwinds from the macro outlook, we just wanted to take a moment to touch upon a bright spot in the industry, which comes from the transition to a greener world. Now, while this topic is certainly not new, it is important to highlight as it is growing in importance for both the supply and the demand side of the equation for the base metals. And indeed, it's particularly timely at the moment, as arguably one of the only silver linings of COVID-19 itself can be taken from the increased shift towards green stimulus in the aftermath, as not only has government-led legislation, but consumer appetite increased towards the adoption of renewable and/or electrification. Now, just as a simple figure, if we compare the level of green stimulus approved 1 year following the announcement of the pandemic versus the same after the global financial crisis, this time around, there is 4.2 times more stimulus being aimed at the sector. So indeed, if we look at the two key areas of the green transition, which can be broken down as renewable energy and electric vehicles. So starting with renewable energy, and that's the chart on the top left-hand side, we can see the dramatic jump in investment towards the sector, with investment lifting by 7% since the start of the pandemic. And this is versus a compound average growth rate of just 2% over the previous 10-year period. Meanwhile, growth for new electric vehicle sales has maintained steady at around 3% growth since 2015. Here, with supply chain issues set to reduce post-pandemic growth levels for this sector. However, if we look to the longer term view, we expect that electric vehicle penetration will rise exponentially, reaching 25% penetration by 2030. And that's the chart on the top right-hand side. Now, if we translate this into what it means for metal demand, copper is set to be a key winner, with total consumption from both of these sectors set to more than double demand over the 10-year period from 2020 to 2030. With copper's chemical characteristics of very high electrical and heat conductivity, while also being highly malleable and ductile, making it ideal for universal green uses. Indeed, we forecast that copper's end use from the green transition will make up more than 50% of its growth forecast over the next decade. Meanwhile, turning to electric vehicles and metal consumption, and this is the bottom right-hand side chart, and this is from lithium-ion batteries. Demand growth for lithium hydroxide, for nickel, for copper, aluminium, lithium carbonate, and cobalt is expected to jump by 11-fold, 8-fold, 7-fold, 6-fold, 4-fold, and 2-fold over the next 10 years, and that's displayed in this chart. However, although we have talked theoretically about the increase in metal demand from both the renewable sector and electric vehicles, here I just want to touch upon the key threats and growth opportunities facing these industries, with a particular focus on developments over the last year. So in very simple terms, on the growth side, we've got strengthening supply chains, we've got the role that green legislation plays, and the role, in a similar vein, of green stimulus. So if we ask the question of where we are at present with these growth drivers, well, starting with green stimulus, the arrival and realization of COVID-19 actually sped up its efforts in the green transition, given concerns were raised that global recovery needs to be driven by both economic and environmental factors. And as we've already mentioned, 4.2 times more stimulus was being directed at green sectors than it was back in the global financial crisis. For the role that green legislation plays, it's less clear-cut, with countries like China having to pull back on emission limits over the last year, instead focusing on economic recovery. And here I'm referring to the fact that no energy intensity target was set this year. Meanwhile, the rise of inflation in the West has actually pushed forward certain government plans, such as the US with the Reduction Inflation Act, which proposes the largest climate incentives and programs the country has ever seen. And for strengthening supply chains, well, these are improving from the peak disruptions that we did see in the first half of 2020, given that the majority of the globe are learning to live with the virus. However, we are still battling against historically elevated freight rates, ongoing COVID-19 spreads in China, and altered trade routes now due to the Russian sanctions. And turning to our key threats. So here we have the price change of raw materials, supply availability, and competition. So if I start with the price change of raw materials that are required for the batteries, this is a very hot topic this year, with critical metals required such as cobalt, lithium, and aluminium having hit all-time highs in March 2022. We forecast, therefore, that given the contribution to overall costs from raw materials to battery costs, which stands at around 80%, this year it will mark the first time in a decade that battery pack costs will increase on a year-on-year basis. Turning to the impact that competition plays. Here, this is both looking at competition internally from changing battery chemistries for electric vehicles and externally from new technology discoveries. And while we do not expect that new external technologies for lithium-ion batteries, such as solid-state batteries, will come into mass adoption by until 2030, changing internal chemistries do remain a threat, with the high price of nickel and cobalt pushing investment towards cheaper alternatives, such as lithium iron phosphate batteries. And if you have any questions on this, please let me know. And finally, supply risks associated to metals that are vital in the creation of lithium ion batteries or for renewable energy. Now, this is a very large topic, and it is not one that we can cover in detail today, but this will remain a key threat, given that we do expect critical metals like copper and nickel to flip into sustained deficits as soon as the middle of this decade. So now, just to end, I want to do a quick summary and conclusion of the key points in today's presentation. So first off, our key macro areas to watch in the year ahead. So firstly, it's going to be the rise in global interest rates, which we expect will continue to weigh on economic growth and sentiment. Secondly, the uncertainty of the Ukrainian war is likely to lead to sustained higher energy prices, weakened sentiment, and further altering of trade routes, in addition to disrupting upstream and downstream activity on a global basis. Thirdly, China's zero-tolerance stance towards COVID-19 will act as a headwind towards the goal of economic stability in the country. While finally, any escalation in geopolitical tensions between China, the United States, and Taiwan will remain a key downside risk for our market. Turning to key micro areas to watch in the year ahead. On the supply side, base metal stocks will be vital in forecasting price direction, given that they remain at historically low levels, which could lead to backwardations and price volatility. Increasing energy and weakening metal prices could create an unfavorable environment for future mining investment, in addition to uncertainty over the political landscape. Meanwhile, any escalation in tensions between Russia and Europe could support a sustained high natural gas price in the months ahead, reducing supply output for high energy intensive metals such as zinc and aluminium, and also alloy steel. Now, on the demand side, the timing of a pickup in Chinese physical demand as a result of stimulus efforts and policy adjustments will be critical to market balances, while the outlook for downstream demand in the West is pressured by rising energy prices. Supply chain logistics will be decisive in the recovery for the automotive market. Meanwhile, net investor sentiment appears to have bottomed out for the year, and this could lend support to the suite. Now, this brings me to the end of my presentation, and if you have any questions, I'll be happy to take them.
Excellent. Natalie, thanks very much. Really, really covered a lot of good ground there and insight in a relatively short period of time. Appreciate that. I've got a couple of questions more specifically about some of the slides you said, and then some more broader theme questions, if you don't mind.
Of course.
Within the lead analysis, on the slide you were talking about the lead catchment for vehicles. Is there a split within that between sort of ICE vehicles and electric vehicles in terms of your forecast? Was the analysis mainly based on ICE vehicles?
So it is a mix, and I think the common theme is what I think that's misunderstood for lead is that people think that electric vehicles means that lead demand won't be used, but
Right.
of course,
Yeah. Exactly.
we know that the majority or all internal combustion engines have lead as lead acid batteries, and when we move to electric vehicles, there still will be the presence of lead acid batteries, but they're going to be used as an auxiliary battery, so to kind of power some of the electronical functions in the car. Meanwhile, the lithium-ion battery will actually, be controlling the engine for the power to drive the car itself. So, the use of lead isn't going to disappear when we do have electric vehicles. There still will be demand for it, but it, of course, is going to be slightly reduced from what we have with internal combustion engines. The majority of the figure as it stands at the moment is for internal combustion engines. And that is because although we have a big growth for electric vehicles, at the moment, it's actually, only making about 3% of global vehicles overall. So growth is strong, but in general, the penetration of the market, it's much smaller. So it doesn't make up a huge amount of demand just yet.
Yeah, absolutely. Excellent. So it seems like overall in the catchment of the metals, there's cooling prices and a more bearish outlook, as you've mentioned, due to many macro headwinds and industrial changes and regional scenarios as well. But the demand remains very robust overall in terms of various industries needing these materials and not enough new supply coming online. I hope that's a sort of fair way to summarize it generally. But I just wondered, this demand isn't, in your view, going to see create this demand coupled with the lower supply is it going to create another sort of surge of, in pricing of the base metals catchment as well? I guess it's hard to say. They're all their own unique markets. But what's your sort of outlook on the pricing?
Of course. So we've had to downgrade our price outlooks both for this year and for next year. As we can see already on a year-to-date basis, if we look at the metals, it's only nickel that's actually so in positive territory. On a year-to-date basis, it's up by 20%, and that's largely been controlled because of the short squeeze that we saw there, and the fact it's kind of been removed from fundamentals. So overall, how I'd kind of categorize it, as you've said, is that the macro headwinds are bearish, and I would say that the micro drivers are neutral to supportive for some of our metals. I would forecast probably across the suite, though, we are going to see kind of on an annual average basis that prices are going to drop for our metals. So, for example, I can go through our price forecast for you, kind of what we're looking at as an average value this year and next year.
Had they run high though? Sorry to interrupt though.
Sorry, of course.
If we think about the sort of last year's metals price boom and the sort of the restart of the global economy post-pandemic, being a sort of fueling the fire of that, it was expected that there would be some correction this year.
Absolutely. Yeah, we do have those base effects, particularly of pent-up demand. I think that we expected demand to be stronger in Europe and the US this year than it has been, because we thought that global supply chains were going to start to ease up. Classic example here is the automotive industry, where we did expect demand to kind of boom this year, but because we've had a lack of supply of semiconductors, not only impacted by the war in Ukraine, because Ukraine actually is responsible for 40% of neon gas, which is used in the lasers for engraving of semiconductors. But supply chains haven't rebounded as strongly, so there are base effects, but also demand has pulled back more sharply than we had expected, and we do forecast that we're going to have improved supply next year, and it's set against this very weak backdrop for demand, and that is certainly going to lead to lower prices for the base metals, I would say, next year.
Yeah. Okay, excellent. Just on the sort of more broader themes and macro themes, obviously in commodities markets and base metals, all eyes are on China. And you mentioned that at the beginning, some of those drivers around Chinese industrial slowdown, but how big a percentage is China when we think about the processing capacity of a lot of these metals, of a lot of the raw materials? how
with
important is
respect,
China to pick up
so on the demand side or on the supply side?
the supply side?
I mean, so China is on the refined side, one of, it's the dominant producer in the world. So it's very important what's going to happen with that. I mean, what we're seeing at the moment is quite interesting. So, the demand side is very weak, and the major impacts of that has been COVID flare-ups, summer drought, and the fact that there's been lower demand. But we are starting to see, it's probably too early to call, but actually domestic demand in the country, in the latest figures that we had out for imports in August for all of our metal commodities, as well as crude, for coal, we've actually seen a month-on-month uptick across all of these commodities. So I think that, we could be at a turning point where we start to see domestic production tick back up. It is very much at the mercy of what happens with COVID-19. I don't think that the zero tolerance stance is going to be removed until at least the end of October, because on the 16th of October, we've got the Communist Party conference where Xi Jinping is going for his third term. So they're not going to have any change ahead of that, but it is possible that they might become softer on COVID-19 moving forward. If they do, that certainly will help the domestic output within China. And I do think it will be fairly robust going into next year. There certainly seems to be enough supply of concentrates, particularly if we're talking about zinc, copper. We've seen very high refined rates, and this year alone we expect both copper and aluminium to have record level of output in China. So the outlook there, at the mercy of COVID, but it is certainly picking up.
Yeah. Okay. Good. Just looking at nickel and the sort of imbalance of supply that, Indonesia being the dominant player, and the increasing ESG mandate from, let's say, European or North American automotives, I'm sure they'd love to get nickel out, Indonesian nickel, an alternative to it, because of the sort of ESG environmental impact challenges that it faces within that supply chain. But there doesn't seem to be any other alternatives available. Do you look at new nickel supply coming online, new nickel mines that are sort of close to production, and is there any significant supply that might be coming online globally that might change that balance of power within the Indonesian producers?
I think that it's very much going to remain a struggle, and I think the best example I can give you here is actually coming from Tesla, where a couple of years ago, Elon Musk said, he'd give a big contract to anyone who could mine nickel sustainably in an environmentally sensitive way. And in the last couple of months, we have heard that, it's reported that Elon Musk is now talking to the Indonesian government, particularly to get nickel supply from the Morowali Park area. Now, this is where they have plants that process NPI to nickel matte, and where they have HPAL plants as well, creating this class 1 nickel, or the intermediate straight class 1 nickel. And I think that basically demonstrates the fact that there is very little choice in the market about how they're going to get this class 1 nickel that they need for the growth that electric vehicles are going to undergo. On top of that, we've had the situation with Russia, which is the largest producer of class 1 nickel in the world. The way they mine that's more of an environmentally sensitive way. They can use their sulfide deposits. I think that's a good example just to show you that, if Tesla are now having to talk to Indonesia about getting material from there, knowing that both those processes, HPAL and NPI to nickel matte, have big carbon footprints, it's demonstrating the lack of option I think there is in the market as it stands.
Yeah. And just wanted to come back to the points of stimulus then. If we're thinking about the energy transition and the stimulus required to bring new supply online, increase renewables, enable more EV penetration, the Inflation Reduction Act was a landmark, and you mentioned it a bit, but do you do any sort of more granular analysis on the impact it might have on upstream material supply? Or it's obviously hard to say now. It certainly provides a great political backing for those wanting to put more capital in. How have you reviewed the act so far? It might be a bit too early to sort of make predictions, but how can you measure the sort of likely impacts of what this is going to do in terms of unleashing capital?
I think that as you've said, I think the headline is a supportive thing for the markets overall, but the specifics of exactly how it's going to work are still quite vague. It's very difficult to quantify, particularly on the timeline when there could be quite a lot of changes going on. If we look at the market reaction to the news that came out, it wasn't very significant. It certainly didn't last long. There's a little uptick for the metals, and then it kind of faded away. I think that indicates that it's certainly not going to be immediate demand. I would have to do more work myself, I think, on this area, but I think at the moment it's still largely kind of misunderstood of exactly how that is going to translate into metal demand. And we have to remember that even though it's a landmark kind of proposal they're saying for climate in the US, the US really are very far behind China and Europe with respect to investment that they have, with respect to even consumer appetite, I would say, for electric vehicles. So it's an improvement, but it's an improvement from a player that was already quite far behind in the transition itself.
Yeah, absolutely. The US is making up some lost ground, but equally as one of the largest economy in the world, it needs a lot further to go. Very good. Well, Natalie, we could ask many more questions indeed, but that's taken us to our time. But just wanted to say thank you so much for providing that really in-depth analysis, and we really appreciate your contribution for this session.
No, it's my pleasure. Thank you.
Thank you.